Hi, everyone. This is Jason Biarco of Wall Street from Main Street.
This is Lee Justo from Risk.
Welcome back to another episode of Finance Unspun. This is episode number 15. And because of listener requests, we got a lot of them. We're having a holiday special, and we have on as a special guest, our first special guest for a Finance Unspun show, trader Aaron from Carnivore Trades. If you're not familiar with him, he does our weekly This Week in Charts videos, which are excellent, 20 minutes or less. He gives us a global macro summary of interesting charts that are going around for stocks, bonds, commodities, the VIX, the dollar index. He covers a lot of interesting charts, probably the best, most efficient show out there. So Aaron, my longtime friend, thank you for coming on.
Yeah, appreciate coming back. It's good to talk to you again. We're doing the show for probably about 18 months now, but a lot of people might not be familiar. You and I have known each other for, I want to say 12 or 13 years now.
Yeah, it's over a decade, actually. We were discussing this before we started recording, and we're recording this on Thursday night, December 29th, 2022. So this is kind of our review for 2022 and our preview for 2023. Yeah, we've known each other. I was doing YouTube videos in 2010, and I was speaking with you around then too. So when I was first getting started, and you said you heard the word podcast from me for the first time.
The first time, yeah, you were the first person I heard ever use the word podcast. Like, oh, that's a cool thing. And that now it's like everybody's got a podcast. Everybody needs a podcast. It's but that's how long it's been there. So.
Okay, so I think we should start first, Aaron, and you've covered this a lot in videos, but maybe get your general census on this. It seems that we have a lot of bear market in the different asset classes, asset price volatility. The dollar is relatively strong versus other currencies. The dollar index is still, I think it's just below 104 right now. The Fed has said they're going to continue to raise interest rates. I mean, we're already pretty high. The interest rates are not fully priced in. So do you expect a prolonged bear market then, maybe with some bear market rallies mixed in these different asset classes?
Yeah, I do think we're still in the midst of a bear market. I think that we'll probably see the worst of it from what I have penciled in right now. I think we'll probably see the worst of it in 2023. But it does seem to be more I hate to use the word secular because that makes it sound so much more worse, but it's closer to secular than cyclical. And it really is. I mean, we have a whole generation of investors that, they think that 2018 was like the worst bear market ever. And and this has been the worst bear market really since 2008. And I do think, if you look at historically, this bear market's way overdue, but historically, most bear markets last 12 to 24 months. I think we're probably, that's why I say probably the worst of it will be over in 2023, but this market is changing, and it's changing fundamentally. We're really not going to see tech outperform this next decade the way that it has in the past. It doesn't mean there won't be winners. Of course, there's always winners and losers. There's always sectors that are going to come out on top. And there's lots of areas for growth potentially, especially in any bear market. There's always opportunity. But I do see it. We're in kind of a state of flux, and I think a lot of things are changing under the hood in really the global macro environment.
And new companies and new industries can be created out of a bear market. So Disney was created, I think, in a bear market in the past. So you have other winning companies. Someone comes up, an entrepreneur, necessity is the mother of invention. You have an entrepreneur or small business owner come out with a new idea, a new product or service that solves people's problems, maybe cheaper and more efficiently than others. So we'll have to see that. But I think that's a good point you brought up. And I want to add some more color to this. Is that the Dow Jones Industrials, I think for the first time in more than 20 years, the Dow Jones Industrials is significantly outperforming tech stocks and the NASDAQ by the largest margin over 20 years. So that is not a risk-on environment. That seems to me to be a risk-off environment. People, professional money managers and retail traders and investors are playing things a lot more defensively than they have in the past.
Yeah, exactly. And I always say, you want the NASDAQ, you want the Russell to be leading. But right now in this environment, obviously rising interest rates, lots of companies betting on low rates forever. And this is the Fed's fault. They've made this bed. They've essentially trained every market participant, every economist, every CEO to just expect artificially low interest rates until infinity. And now it's starting to come time to pay the piper. And so these companies are underperforming now. They're getting thrashed. and you're seeing blue chips. We're actually seeing Exxon. I believe Exxon is now back in the top 10, I want to say, in market cap in the S&P 500, if I'm not mistaken. I believe it's, number 9 or number 10. And you've had other stocks, Tesla, Nvidia, some of these other darlings, these tech stocks that were previously in even the top Apple. 10 or very close. They've fallen from grace.
Yeah, even Apple's getting crushed. Apple's down, 28% in the last 12 months?
Apple's down 20%. Tesla down almost 70%. Tesla's down, I think, 40 or 50% in the last month. I mean, literally, it was $300 stock. I want to say, I'm just taking a look at the chart here.
Well, Elon's got marching
$200 stock. $200 stock at $200 stock on December 1st, and today it's 121 after bouncing off of 108 a few days ago. So these are massive. These are big time haircuts, and this is something that myself and a lot of other people said in 2020, 2021. Why the hell would you add this company to the S&P 500? It's going to be a tumor. It's going to be a tumor, and now it's guess what? It's becoming a tumor.
Lee, were you trading at a Wall Street investment bank still during the tech bubble?
I was trading for a boutique firm back during the tech bubble.
Are you seeing a lot of similar?
A lot of the companies that were big and hot. Oh, there's no question about it. I mean, now it's like back to 2001 when it was just dead after, September 11th, and volume just dried up. People lost interest in trading. It was a brutal time. And that's kind of where we're heading, I think. If you look back a year ago, the things that were leading the market were crypto and the NASDAQ, and now they're just both dogs. Are you trading, Aaron, the NASDAQ at all?
Oh yeah, I mean, I'm a trader at heart, so I mean, I'll trade anything that's got volatility. Oh, yeah. But yeah, I mean, it's and it makes. I mean,
but I'm saying it's been dead, right?
It's not. I mean, the volatility is great though. But I mean, as far as being a dog, yeah. I mean, especially you mentioned crypto, like Bitcoin. It's just been a stair step down. I mean, ever since November, we've just been sideways, and then June we had the big drop, but then it's been sideways. I mean, crypto's definitely been a dog. I'd say the NASDAQ has been good to trade, at least because you get these big swings with the FOMC pushing the market like crazy, and bear markets do breed volatility, so it has been good to trade. But I mean, for a long-term investor standpoint, of course, you're getting killed here. You're getting killed if you're owning these.
I wouldn't want to be trading crypto right now though, because it's just there's no volatility, there's no movement at all, right?
Right. They're trading crypto right now. I talk to a lot of guys who trade crypto, and they're kind of they're over it at this point, or they're very frustrated.
But Aaron,
I would imagine. Have you been trading the? I was going to ask if he's been trading any of the blue chip companies.
Yeah, a little bit here and there. I mean, I like to pick. If I'll trade, like I said, I'll trade anything as long as it's got a good level, a good chart set up, and I like what I'm seeing. It doesn't matter to me. I'll trade a blue chip. My philosophy is, typically with trades, if I'm trading a blue chip, I'll put more capital into it. Whereas if I'm trading like a growth stock, I tend to dollar cost average or start with a smaller position because the volatility makes up for the risk essentially.
But Aaron, you said
that makes sense. Yeah.
But Aaron, you said you expect some type of bear market rally in the not too distant future, probably a short covering rally more than based on any fundamentals for companies like a Tesla or an Apple.
Yeah, I do think so. A couple of things here. So we talked a little bit beforehand about energy stocks, and if you remember on the show on This Week in Charts, I want to say about a month ago, I talked about Exxon and really the XLE stocks, Chevron, Conoco, those names. They've outperformed. And I said they'll probably keep these stocks held up until the end of the year for two reasons. One, the end of the year, all these fund managers that got crushed this year, they want to put these stocks on their balance sheet for the end of the year so that prospective clients can see, oh, they owned Exxon. It doesn't matter if they actually owned it from the beginning. They just see that they owned Exxon, so they think that this fund is smart. Now, secondly,
it's for marketing. Yeah,
right, exactly. Secondly, what they're doing is they're throwing the baby out of the bathwater on Apple, Tesla, Nvidia, all these Cathie Woods to ARK. All those are getting thrown out the bathwater, and so they're using their window undressing tech and their window dressing energy. I think what's going to happen once this tax law selling is over with and we roll over to the new year, we'll see a rotation from energy to tech for the first couple of weeks of January. You'll see a very good rally. Like I said, Tesla's down like 40% in the last couple of weeks. That's not sustainable. This will rally very sharply. Apple will rally. These tech stocks will have a day, but
depends how much margin
it's a selling
calls.
opportunity.
Depends how much margin calls Elon gets, right? Because he had a pledge for listeners out there who aren't aware. He had to pledge a large chunk of his Tesla Motor stock as collateral for the loans from the investment banks to go and buy Twitter.
I think for him, he has to announce a Twitter CEO. If he does that, Tesla will probably rally. That's a lot of the reason why it's selling off too.
It's just funny though, like Lee and Aaron, just seeing the tweets and the other social media posts from these Tesla permabulls, these Tesla pumpers that Elon may or may not have been paying to make YouTube videos for years now and help manipulate the stock price higher. Now their argument, even though Tesla shares are down 70%, is that it is a value play with lots of free cash flow and none of the growth is priced in. They've just kind of reverse the frame here. The spin is that like Tesla is a value play, even though if you look at a lot of the valuation metrics, I mean, like it's still definitely not a value play, especially when you look at a lot of other stocks that have more consistent profit margins, free cash flow. They have a history of earnings and dividends. So I would say that Tesla is not a value play like a lot of these people are spinning it out to be.
It's really not even a debate. I mean, it's not even close.
Yeah. Hey, but you know when your stock falls from 400 down to 121, you got to change the sales pitch of it somehow.
Right. Yeah. I mean, yeah, he's trying to do what he's trying to do to say. I mean, he's the CEO. He's not going to say something bad, but yeah, I mean, he's trying to change the sales pitch. I think he really needs to announce a CEO for Twitter. That will probably help him a little bit at least.
So another reason for, I think, why we're going to have at least a bear market for I would say at least the next 18 months, give or take, that I don't think stocks are immediately going to rally is because of the bond market, credit markets, a government debt crisis. And it's not just the US. We have all these governments that have overspent drastically. And really the last 2.5 years with the pandemic, we had governments go into basically war spending amounts where they increased spending massively. People stayed at home. Governments sent out stimmy checks. Governments bailed out businesses. So that just increased the government debt problems massively. And then a lot of these other currencies, not only did you have supply chain problems, you had countries like Japan, Germany, and China import massive amounts of energy that they didn't need to in the past. So they weren't running trade surpluses. They weren't buying US treasuries. And now you have inflation problems and the governments can't buy the US treasuries, and in their currencies are starting to get, and Aaron, we talked about this before we started recording, the currency moves for a lot of these currencies. In the past, historically, you would only see in a single year a currency move on a currency pair 2 to 5%. Maybe that was considered a pretty big year. Now, and we're starting to see this like almost on a daily basis, big moves in currency exchange rates.
Yeah, I mean, absolutely. It was funny. I did an interview a month or two ago with Chartman Dan, and when he talked about the dollar index. It's funny how everybody's got a chart of the dollar and like the 2-year treasury on their screen, at all times. Whereas like years ago, that was like, something that only the fossils looked at, what I mean? Like where the dollar index is moving like 100 basis points a day, yeah. And the 30 years moving like, 50, 100 basis points at a time. Like this is supposed to be the most stable asset in the world. And it's trading like a crypto coin. It's insanity here. I mean, and it's just showing you what happens when the punch bowl is getting taken away, how much this market was repressed for the last 13 years.
Well, the other currencies like the Japanese yen and emerging
Aaron, are you expecting a rally in the dollar? I'm sorry.
I am. I think we have one more low to make. I do think we have one more little bit less correction to make. I think there will be I think the dollar will rally very hard in 2023.
Well, I think at some point the U.S. Treasury and the Fed will step in and they will prevent the dollar index from getting too high, and they'll just start flooding liquidity, or they'll announce like some type of they'll announce like, I don't know, currency swap lines publicly even more than is already going out, or some of these permanent Fed repo facilities. You'll start seeing more drawdowns, more announcements that other countries are using that, because really when the dollar gets too strong, it becomes a global margin call. You have all this dollar denominated debt. The story that came out in the last 4 to 6 weeks that everyone's talking about is the Bank of International Settlements report about how much there's tens of trillions of additional dollar denominated debt outstanding that a lot of people were not aware of. And that just adds to the fact that when the dollar gets strong, all that extra dollar denominated debt, the dollar derivatives, the interest rate swaps in the derivatives market, all these things become onerous for banks and hedge funds that were playing all these leverage trades.
Yeah, and they're going to have to do this with 7% inflation.
That's the official number. Yeah, I mean, shadow stats. We peaked.
We're just giving them. We're going to give them the benefit of the doubt for now because the 7% is bad enough.
Well, according to shadow stats, we peaked around 18%.
So if the dollar rallies, do you
go ahead, Lee? Sorry for interrupting you. Go ahead.
I was going to say, if the dollar rallies, do you see gold and silver softening a little bit in response to that?
I do at first. So I'll just let you know right here. Let's debut it right now. So I think specifically gold more so. I think silver has already kind of made its move, but I think there will be a major, and I mean major, buying opportunity in gold in 2023. And it's, I guess the best way to put it would be flash crash. And I think when that happens, you'll see the dollar surge higher. Financial markets will panic. And it'll be, like every other time we have this type of event where, gold sells off very quickly due to margin selling and panic, and then it recovers faster than anything. And if you take a look at GDX right now, it's something I mentioned, or any of the miners really, they've been holding up really well, and they've actually been leading the metal for quite a while. That does indicate to me that there is institutional accumulation. Smart money is accumulating. That doesn't mean that we can't have a drawdown, right? But I think the writing's starting to to see the clues start to get put together here.
It does make sense, Aaron, because over the last couple months, I mean, from a profit margin standpoint, the metals, gold and silver prices have, on a relative basis versus a lot of other asset classes, especially against other commodities, they've done very, very well, especially in a relatively strong dollar environment. Gold and silver holding up pretty well. But now oil and energy prices the last 4 to 5 months have come down sharply, especially oil prices. I don't know about global diesel prices. Some diesel prices all over the globe, some of them have come down 20, 30%, depending upon which country you look at. So from a profit margin standpoint, if the metals prices aren't crashing and the energy prices are coming down, that's going to be good in the short term, at least for the mining companies, the gold miners, the silver miners, the copper miners.
Yeah, I do think energy's, I'm just looking at a chart of gas futures right now. It's at 430 in June, and it hit a low of basically $2 a couple of weeks ago. I do think energy is still doing some backing and filling. I think it's in correction mode, and I know everybody wants it to go up, everything in a straight line, but it takes time. When you have parabolic moves like we had last March, especially with crude, it takes time to digest that. And I think we're back in filling, and obviously, like you said, the miners and
the March was geopolitical, wasn't so the March move was there was a big geopolitical risk premium, right, with Russia going into Ukraine, and there's a fear that a lot of supply was going to come offline.
Right.
But then you had China, locked down. So a lot of Chinese demand came offline. Before I start recording, I was going to bring this up. So do you think then that whether or not China comes back online, whether the Chinese Communist Party actually allows the Chinese economy to reopen, that's going to play a major factor for demand drivers for energy?
Yeah, I can't tell you. For one thing, I've been public about this. I won't trade the ADRs anymore. Alibaba, Baidu. I used to love trading them all the time. Pinduoduo. I can't trade them because I don't know what the Chinese government is going to say. I don't want to wake up to be in a swing trade and wake up and my position's down 20% overnight because of some bureaucrat. So it's really hard to say. I think they're posturing. I think, if they wanted to reopen, they would do it. I think the data and the news headlines that comes out of China are very suspect. So I'm not sure about them going online anytime soon, but for me, it's just so hard to tell with their government, the way that they operate.
Yeah, Kyle Bass, since we're going to talk about this, Lee and I were discussing this before we started recording. Kyle Bass did a recent interview over on the Blockworks Macro YouTube channel with another hedge fund manager, Nicholas Glinsman. And he was talking about how he's starting to, because on a valuation basis, look at oil, natural gas, and uranium plays. He's like, energy looks cheap. But then he also, on his thesis, was saying how the Chinese government was going to keep China locked down. So I was kind of wondering, I guess on a valuation standpoint, For a lot of these oil and natural gas companies, there's still a lot of them still have like their hedges in place for oil and natural gas prices at higher prices, and they have profit margins. And I guess and there's still a lot of supply side problems. But if there is a lot more demand where China does come back online with Chinese flights driving in China in their economy, that would add a lot more demand, and then the supply problems would also react, and you'd have higher oil and natural gas prices. I agree with you. I think we're going to have probably continued weakness in oil and natural gas because that's like the short-term trend for another maybe couple quarters, at least 2 or 3 quarters, I would say. So maybe by the Q3, mid to late Q3 of 2023, I would say. So around like summertime seasonality for oil, the demand tends to pick up here in the United States again around summertime, summer driving season. So we'll see if that plays out. But I think in the short term, we could have more weakness for oil and natural gas and diesel and gasoline prices. Uranium is also uranium doesn't have any short-term demand drivers because it takes so many years to bring online nuclear power plants.
Yeah. And to another thing, I mean, you're going to hear pretty soon, it's going to happen sooner or later, but recession, that's going to be all you're going to hear. And that's going to put pressure on oil, at least in the near to medium term, if you ask me.
Haven't the hedge fund managers already done that though? I mean, like most of them are Keynesian and deflationistas, and they mentioned demand destruction. Although I heard one weird comment from a new hedge fund manager that has only been on the scene a couple of years. He did a podcast interview and he said he's short inflation and long oil and accumulating. I was thinking, like, how does that make any sense? Because if he's betting on a big spike in oil prices, won't that eventually mean higher prices, higher cost of goods sold, and more inflation for a lot of consumers and small business owners? Because once oil prices and diesel and gasoline, those things go higher, that's typically inflationary. So it doesn't seem to make a bunch of sense, but it sounds like it's a trade he's putting on.
I've never heard of anything like that. Sounds like he's long the 2-year or maybe long bonds of some nature.
And oil. Yeah, it's a mixed trade.
Yeah.
But then again, he's still betting that would be betting on the Fed to reverse.
I think that there's a good case to be made that we're going to see, a bear market in real estate and
I agree.
Many investment assets. So that is extremely deflationary.
We haven't had a real estate
but at the
crash
same
yet.
time, and at the same time, we could still have like extreme inflation in certain like core necessities like food and energy.
Right.
I mean, the two
Which
can
they conveniently
happen at the
leave
same
out
time.
of core CPI, of course.
Well, it's government distortions. I mean, so you have the Fed creating distortions with monetary interest rates and monetary policy, and then you have the governments creating even more problems with in the European Union. You have all these oil and natural gas drilling bans instead of allowing oil and natural gas companies in Europe to make more investments and invest in new supply. You're talking about price caps, windfall profits taxes, more restrictions on oil and natural gas drilling. So basically the opposite's occurring of what should be occurring policy-wise.
And they want them to, they're going to do windfall profit tax, but they also want them to invest CapEx into oil and gas exploration.
It makes no sense. It's similar. It's similar to the distorted policies that are contradictory of what the UK government did, the Bank of England did when they bailed out the pension funds a couple of months ago, because what they were still talking about raising interest rates, but then they also needed to do QE and buy government bonds to try to cap rates. And then they went to the Federal Reserve Bank to get a $600 billion, or at least that's what I heard, currency swap line bailout, or the pension funds were going to have margin calls and collapse. And then the banks who loaned to the pension funds were going to collapse. Yeah.
Speaking of pension funds, they're not doing too hot this year with those bond trades, huh?
Are they? They're not. They overinvested in real estate too, Aaron. So they're going to have They overinvested in commercial real estate. Around here in the DC metro area, real estate investment trusts and pension funds own a lot of the strip malls and the luxury condo buildings. So, I mean, eventually, I'm sure that's the same in many other areas too. I mean, we're going to have a real estate bust.
Oh, yeah,
well,
absolutely.
You're seeing all these malls throughout the country just shut down. They're dying. There's just no retail.
Yeah, and
everything's going online,
or
like
a ghost town.
Did
just one big box store.
Did you see like the videos that Amazon buys some of these old shopping malls for literally pennies on the dollar and turns them into like warehouse hubs?
Yeah.
It makes sense to me from a business standpoint for them to do that because, malls are going to be on the cheap for a long time.
Yeah.
And, I don't know if you caught this in the Kyle Bass interview, Jason, where he was talking about the Chinese market in real estate. And he was saying that median home prices there became 36 times median incomes. And in our subprime mortgage crisis, it was only 6 times. So they are so far overvalued over there. I don't see China coming back anytime soon.
Well, that's bad central planning. I mean, they grew their money and credit bubble faster than any other country in world history. So yeah, the Fed did a bunch of quantitative easing and inflated asset prices, caused a lot of inflation. A lot of that monetary inflation since 2008 went into asset prices. The Chinese grew credit in their own economy. In 2007, it was below $2 trillion. And by 2019, it hit 50 trillion or over $50 trillion. So that is the fastest it went up. What, over 25x?
So you're saying that in China, like the train cars that are full of rotting grains and corn, while their people in Shanghai are literally starving, that's bad central planning?
Yeah, if the Chinese Communist Party officials didn't already steal the grain or the food out of the warehouse and resell it on the black market and pocket the cash. There's been a lot of stories about that over the years too. I mean, I'm criticizing the Chinese government right now. All these governments are all doing bad policy. There's so much corruption. There's so much corruption here in DC. I mean, it was like the Hunger Games having Zelensky come in front of both political parties. You didn't have all the lavish costumes and the weird colors and BDSM and sex toy stuff that was in the Hunger Games with all the different actors in front when their government officials were speaking. But it definitely reminded me where they were bringing Zelensky in front with the flag and all the barking seals that were clapping, that were getting rich from both political parties, just congratulating him. I mean, they're stealing so much money from the taxpayer and all the dollars being printed. And the military industrial complex is just getting rich and fat and happy. And both political parties are parasites.
Yeah. And somehow we have 4.5%, interest rates. And it's like the second the Fed started raising rates, we started spending more. It's literally like the most backwards line of thinking ever. Like we're spending worse than ever with rates going up.
Well, no one in DC cares about the total size of the national debt. It is all about if you can pay the interest payments. So it's like the person out there who opens up all these credit cards and maxes them out. Can you make the minimum payment? But eventually you're screwed.
Yeah.
So the US is being saved for last because we're the world reserve currency on a relative basis. Our economy is in better shape than a lot of these other countries, especially emerging markets and countries like Japan and others that have all these problems with their zombie banks for 20, 30 years. China has their credit bubble. Europe is a mess with especially energy, but other things as well. I mean, European banks. Aaron, you've been covering this. I haven't seen this really anywhere else yet because you've been covering the charts. I mean, these bank stocks are starting to send big signals. Do you think it's just with non-performing loans in real estate, or do you think there's other serious problems that we're not aware of yet with the banks?
I'd like to say it's just the former, but I think it's the latter because it's something I pointed out. Like you said a few weeks ago. The market, this S&P, the NASDAQ was holding up okay pre-FOMC in December. I was just kind of stuck in a trading range here. But you look at Bank of America, Wells Fargo, Citigroup, they all of a sudden just the bottom fell out of them. And I'm not talking about like a little pullback here. I mean, Bank of America went from 38 to 32, which is a big move for Bank of America in about 4 days. And it wiped out basically a month and a half worth of trading. And when I see something like that, I've been doing this long enough to know when the banks just the bottom falls out of them for no reason on no news, there's something stinks to the high heavens, and we might not know what it is yet, but I'm telling you, this does not look normal to me. It does not look like, we got some, the yield curve's inverted, so our bank earnings are going to take a hit. It looks much worse than that to me.
But I thought the Fed raising interest rates, the European Central Bank raising interest rates was supposed to be good for the banks and bank spreads, except that the banks have large derivatives positions that they built up for hundreds of trillions of dollars over the last 20 or 30 years on interest rate swaps where they were betting on lower interest rates.
Yeah. Well, I know this is a surprise, but they lied.
Yeah. Well, yeah, if the banks weren't doing derivative trading like hedge fund, like over leveraging on risk parity, the 2019 repo crisis, which blew up risk parity, and that was the last rate hiking cycle, and there was many trillions in bailouts that were secretly needed, bank bailouts and hedge fund bailouts during the last Fed rate hike cycle. So like old boring banking, okay, if the Fed is raising interest rates, then it's a spread, right? So the banks would borrow more and be able on a higher yield curve to be able to loan out more at a higher interest rate. But that's not the over leveraged balance sheets that the banks have with all these derivatives bets. Yeah, Credit Suisse seems to be the major problem because their shares are sub $5. So So you're going to start to see the institutional investors, so the pension funds, the mutual funds, if those shares are not fixed above $5 soon, you're going to start to see forced selling, and it's going to create a vicious cycle. They're probably not going to be able to get away with the games that Deutsche Bank was able to get away with for many, many years to save itself, where they did reverse stock splits and then sell more shares at a discount to sucker pension funds.
Yeah. Here's one last thing about the banks. Here's a theory possibly that could be something to look at. FTX, you mentioned that you mentioned that the banks were, gambling on leverage trades and all this stuff. Supposedly they won't touch FTX, but maybe their clients would. And if you look at historically when like big institutions blow up, Bear Stearns blew up in March of 2008. The crash didn't really happen until later. Now Lehman Brothers happened, and that was like 2 weeks later that you had a really crash. But sometimes these things take time. There's nothing to say that some of these banks weren't exposed to that or something else that could be going toxic at this current time. So that's a good honestly, point. We don't even know how deep the FTX thing goes. Like we still don't.
So Bear Stearns, for listeners not familiar, 2007, Bear Stearns had a number of hedge funds blow up, and it was excused as, it's only a few hedge funds. Bear Stearns itself is fine, even though I think they were levered, their balance sheet was leveraged 60-1, which means that a 2% drop in their asset prices on a leveraged balance sheet, that leverage would blow them up. They'd be insolvent.
Wait, are we that old? Do we need to explain Bear Stearns? Are we that old? Do we need to explain Bear Stearns?
Well, we have younger millennial listeners here, so just give a quick recap here, where they were able to explain away almost for a full year that things were okay with Bear Stearns, and then Jim Cramer tried to paper things over with Bear Stearns. So they bought themselves about a year, and then Lehman, I think, was 6 months after Bear Stearns, something like that, and there was a bunch of shotgun wedding. Now, Lee, didn't you send me something months ago about Credit Suisse, right? They have a bunch of collateralized loan obligations, which have worse collateral than junk bonds. I think Credit Suisse may have gotten stuck with tens of billions of those they couldn't offload in time.
Yeah, I remember that. That was a couple months ago. We haven't even talked about FTX. I mean, who knows how deep that goes and what the exposure is on these big banks. And
well, I mean, pension funds.
How deep are they into China with the real estate? I mean, there's just.
Well, I think our biggest clues for Chinese real estate problems and problems with the banks are the large real estate funds that shut off withdrawals. So what you have, Blackstone, and then what was the other one? Starwood. So you have, those are red flags.
It was Starwood.
Yeah. So there's
right?
two.
No.
There's two funds that have shut off redemptions. Now, we haven't had the crash in the United States yet, the real estate crash yet, but there's large scale commercial real estate vacancies right now that we haven't seen in many, many years. We haven't had the big home price residential, excuse me. We haven't had the residential real estate crash yet. But if this continues, I mean, anecdotally, I'm just hearing stories, and real estate agents are basically salespeople. So if they're not selling homes or condos, they're not earning a paycheck. So a lot of people anecdotally here at DC Metro area real estate agents, they're looking for other sales jobs. In other industries.
The 30-year mortgage is up to 6.42. I mean that. Yeah,
but even if you have a perfect credit
it's hard to buy a house right now.
If you have a perfect credit score, Lee, I mean, even if you put down a large down payment, you're still not able to borrow below 7%. So it's 7-8%, even if you have a perfect credit score. If you don't have a perfect credit score, I mean, you're borrowing way higher than 7 or 8%.
Now, the National Association of Realtors are saying that the existing home sales were down almost 20%. And that's as of September. So I'm sure it's actually gotten worse. So if you're a real estate agent, like you said, you're starving right now.
Well, you're looking for other sales jobs. So you're going to go into maybe pharmaceutical sales or tech sales. Around here in the
Yeah.
DC metro area, there's opportunities. They're going into, this is anecdotally, obviously, but they're looking for other sales jobs in other industries. And they expect, from speaking with real estate agents here in the area, they think things are going to be pretty bad for at least 18 months.
A sector that's interesting
I don't
to
think
me
they're
is
getting any better anytime soon.
yeah. What's interesting to me is I'm looking at a chart right now of ITB, which is the home builder ETF, and that still hasn't broken the November lows. That's actually kind of near the highs, and the home builders seem to not really be reflecting this carnage quite yet. I think, I've been telling my traders this is a sector that, I mean, I'll probably be looking to short next year. It's holding up really well, and I do think that the market's not really priced this in quite yet. But there's 450,000 FHA delinquencies right now. That was actually a stat from a couple of weeks ago.
So, Aaron, I've talked about this a little bit. There's actually a lot of foreigners. So if you're in a country, in Latin America, where in the last 6 months you just had a socialist politician elected talking about windfall profits taxes or forcing wages higher or confiscating your business or other types of things that are going to hurt your net worth or hurt or destroy your business, you are looking. So Chile, Colombia, Brazil, many of these other countries, there are a lot of affluent people in those countries that are looking to buy real estate still here in the United States. So that, I think, is a large part of the demand picture still here in the United States.
That is true. There are a lot of foreigners buying up real estate in cities, pretty much in every city, really. And they're buying it anywhere they can. Doesn't matter if it's in the inner city in the slums or if it's in wherever they can get it.
Yeah, my best friend is a successful real estate agent here in the DC metro area, and he said pretty much within a couple weeks after the elections in Chile and Colombia, he was getting calls from people who were looking to start buying real estate in this area to start diversifying out of those countries.
I believe they actually banned in Florida. They banned purchases from foreigners temporarily. I believe I read.
Oh, that's interesting. Are they banning Hugo Chavez's daughter and Maduro's friends and family?
Yeah.
All the Venezuelans who stole all the money from the Venezuelan government, Venezuelan military who laundered and stole all that oil money.
Yeah.
I know about half a dozen Venezuelan expats, and just hearing the stories of all the waste, fraud, corruption, abuse in that country is really tear jerking. It's totally sad. All the oil money that's been stolen that wasn't spent on the Venezuelan people and their economy. Okay, well, Lee, is there any other topics? Since I know
the Venezuelans have certainly gone through a very rough time.
Yeah, I think we went through most of the topics. So, any other topics that we wanted to cover for the year-end show? Brief summary, Aaron. Then of 2023, then you see a lot more volatility in different asset classes. Even if the Fed does do a 180 in reverse, you don't expect a big rally or a bull market immediately. Then would that be fair to say?
No, because what'll happen is the Fed's. This is what I see happening. The Fed will eventually, they're going to have to pivot. But they've actually stated, and the Fed does this, right? The Janet Yellen in early 2021, she said, oh, interest rates rising would actually be a good thing. I said to everybody, look, this is their way of telling you that the rates are going to go up. And they telegraphed this 7-8 months in advance. What the Fed's doing now is they've literally come out and said, even if we stop raising rates, they're going to remain elevated for a while. I think the Fed pivot, that's going to be the ultimate sell the news, because it's going to be everybody's, oh, the Fed's pivoting, it's going to pivot. But then it's going to come to the quick realization, wait, why are they pivoting? Oh, because it's that bad. And with inflation as high as it is, they're not going to be able to turn the printers on right away. They're going to wait until they absolutely can't do it anymore, and then they'll have to turn the printers on. But by that time, the damage will be done.
Okay, so by printers, do you mean handing out stimmy checks, or do you mean they're going to have to buy government bonds, because the normal purchasers in large scale of U.S. Treasury, say China recycling reserves, Japan, Germany recycling, they're not there.
Right.
So they're gonna have to buy government bonds, but you're not expecting then the normal asset price inflation for other asset classes or stimmy checks that the Fed would normally give out?
I don't think it will happen. It will happen, but I don't think it's going to happen the way it traditionally did. Like it just the first sign of downside. Oh, QE infinity, get Apple up to all-time highs again. Like
here's a 2000 stimmy check. Yeah, we're sending out 2000 stimmy checks. Go and buy some meme stocks. Go and buy some crypto or go and trade stocks or go and buy some asset classes or go out to buy some luxury goods. I mean, they have to buy the government bonds though. So I mean, but
here's the other thing though. We haven't even felt the effects of the second 75 base. But do people like, okay, so you talked about younger viewers. Okay, so you guys who haven't been investing that long, this is unprecedented what the Fed's doing. Right? Like this is one of the most aggressive rate hike cycles of all time. We haven't even felt the effects of, like I said, like the second 75 basis point hike yet.
I don't even know if we have the rate hikes priced in from 6 months ago. These things take these. So for if you're a junk bond, if you're a corporation and you're trying to issue like junk bonds, your cost of capital went up enormously, you canceled projects, but we're not seeing that throughout the entire economy yet. So for real estate, the asset classes that are the most sensitive, so bonds and real estate, those are the two most sensitive asset classes to interest rate hikes. But the rest of the economy, I would agree, Aaron. I don't think we've seen the rate hikes from even 6 months ago, because these things can take 6, 9, 12, sometimes even 18 months for them to filter through everything.
Yep. I said on the 13th, which was the previous FOMC, I said to my viewers in my video, I said, look, the Fed's going to overdo it. They've probably already overdone it. They don't even realize yet. So headline inflation is coming down, right? So take the number for whatever you want. Okay. But it's coming down, right? So why are they still raising rates? Do they not realize what's about to happen? Like Jerome Powell will be, mark my words, the last person in the room who realizes what he's just done, and he'll realize it way too late.
Well, or the people at the Fed have lots of out of the money puts, or their bankster friends.
Oh well, of course. I mean, we don't need to. Everybody knows that. I mean, why do you think they sold the top last year?
So they're raising the interest rate. They're raising interest rates, and they're like, "Ooh, those out of the money puts. I'm going to get extra $5 million. I'm going to go buy another beach house."
Yeah, yeah. That's why they sold at the top and then retired.
Well, you guys sound like a cynical bunch.
Yeah.
What did you say, Lee?
I said you guys sound like a cynical bunch. Not that I disagree with you, but
I've lived outside of the DC metro area for 20 years.
The Fed always overdoes it.
Yeah. Oh yeah. They've never been able to engineer a soft landing. Like what kind of nonsense is that talk?
And they've generated basically every bubble that we've lived through.
Right.
So they get it on both ends. Well, I think this was a great show. I appreciate the time, guys.
Did we cover everything on the outline, Lee, that you wanted to cover?
Pretty much.
Did you want me to bring up the 0 DTE thing?
Yes, that was the other thing. So before we started recording, Aaron and I were discussing what was bringing extra volatility. So what the Chicago CBOE, Chicago Board of Options Exchange, created a new product, Aaron, and you're saying that now it's creating even more volatility, even shorter cycles?
It's like shorter cycles is an understatement. So if you're familiar with the options market, for many years it's been so on the spiders, the S&P 500, the triple Qs, and most equities have options that expire on Fridays. A number of years back, they made just the SPY, the QQQ, and I think the Dow and maybe the Russell have Monday, Wednesday, Friday. And that means that every Monday, Wednesday, Friday, there's an option expiring on that day. If you know anything about the options market, you know the market makers don't want to pay those out. So they use their capital to push the market where they need to go. On November 14th, the CBOE started doing options expiring on the SPY and QQQ every day of the week. And this has skewed the VIX. The VIX is no longer reliable. The put call ratio hit hit an all-time high yesterday. And when you see that, it's normally an indicator of like we're in free fall, like 2008, 1929. None of that's happening. Why? Well, because there's zero DT options being gambled on by algos and retail traders and probably institutions as well every single day. And it's causing an enormous amount of distortions in the market. It's literally changing the entire game. It's breaking calculations. Like I said, the VIX is skewed, the put call ratio is skewed, and it's almost like every day has its own business cycle now. Because as soon as those hedges expire, the next day they mean nothing now. So you're getting wild volatility on a day-to-day basis now.
And the stock market's not reflecting the bond market, the credit markets yet either. So I think there's a big divergence there between the inverted yield curve. So the credit markets, real estate imploding, bank stocks, and then the yield curve in the US is telling a different story than potential stock market rallies. Last question, Aaron, before I let you go, and Lee, you could comment on this too. So I saw an interesting report come out in the last month or so from Bank of America analysts. They're being kind of contrarian for their investment analysts from a large bank. I was surprised. So for 2023, they're predicting the top performers. They have copper as their top performer, gold as their second best, and then U.S. Treasuries. So kind of a safety trade with U.S. Treasuries rallying on capital gains if the Fed, I guess, does a 180, reverses, and then goes back to bond buying and lowers interest rates rapidly, and then also gold. And the most surprising one out of the bunch of the list there for the contrarian trades and the safety defensive stuff was the copper being their top pick for, I think, a 25-30% gain rallying the copper price. So what do you think about that? Or if you had to make an educated guess, because obviously things can play out differently, what would you expect then for commodities or asset class sectors to be potentially for top performers in 2023?
It's tough. I think gold and silver, and I think bonds will get a rally. Certainly as there's more fears and more of slowdown type action happening, and gold will become a fear trade as well. Copper, that's definitely a little bit of a surprise there, because that does kind of seem to contradict a little bit kind of the gold. Well, I guess copper right now has been more of an inflationary trade for the most part. But as we know, it also depends on the yield, because if the yield is rising, that could be bad for gold. So it's a weird kind of nexus.
I view copper as more of a health of the economy or real estate construction or electric vehicle, electricity, ESG type of trade. But I don't know if there's a problem.
It could be ESG related. That might actually be a little bit more accurate to put it that way.
Well, yeah, because these electric vehicles, the amount of copper used for them, they use a lot more silver and copper than a regular car.
Yeah, if you look at a chart, I just pulled up a chart of First Solar, FSLR. It's a big solar company. That's basically at all-time highs right now. So some of these ESG names are, just bidding up, and they're avoiding the bear market just because of, government subsidies, and so they're able to kind of withstand that. So I guess that would make sense then, if you're looking at it that way for copper, for definitely in that regard.
Yeah, I want to agree with you guys. I don't see copper rallying in the traditional, like Dr. Copper, the economy's roaring back. I think it's more an ESG kind of play.
Yeah,
and I believe the bonds and the
ESG. Yeah, I
right.
think
and then I think gold and silver and bonds. I think that's going to be more a flight to quality.
Well, I think bonds are just a trade then. I don't think they're a long-term investment. Maybe they're a short-term trade, because I know a lot of hedge fund guys are starting to really get aggressively with their U.S. Treasury purchases, betting on the Fed to do a 180. So they're betting on capital gains and the Fed doing a 180 at some point, probably first or second quarter of 2023. But I think on the charts, Aaron, you could talk about this. I mean, we're starting to see really good base building higher lows for gold, silver, platinum, and palladium. Platinum and palladium are also looking good, but those are all byproducts, though, of base metal miners. So if there's a lot of base metal supply coming offline from some of these higher cost mines with low grades for base metal, for iron ore or copper, that would be good for on the supply side for gold, silver, platinum, and palladium.
I'll tell you, I like platinum better than right now. I like platinum better than all the metals currently. If it right here we are today. By the way, platinum was up 5% today and had a beautiful consolidation pattern on the charts, and it's pushing up. I think this wants 1,200 over the next couple of months.
And for energy, you think then weakness for at least a couple quarters then, but it sounds like a lot of the really smart money, the hedge fund guys, are starting to accumulate very big positions, but I don't think it's probably a short-term trade for a big energy rally. I think we're going to have a big rally probably by mid to late 2023, though. I think we're going to be looking maybe at a repeat. Unfortunately, I hope not, because the volatility and all the problems it caused. Similar repeat maybe with 2020 and 2021 cycle with energy prices, where we have more weakness in the short term, and then we get a big spike later, either later in 2023 or mid to late 2023 or early 2024 with similar supply problems.
I think that's what's more likely to happen. But right now there's higher floors.
Well, yeah, the costs are up. I mean, the cost to drill these oil wells are up a lot. They're up way more than 15%, depending upon like which region you look at. I mean, the oil service companies, I had one troll tell me Schlumberger was not cash flow negative. In the Q2, they were, and they were talking, I read the report myself on their website, their financial disclosures, and they were talking about how like they have to raise prices and fix their cash flow problems. Yeah. So you're going to see oil services raise prices.
And I think it'll be the thing with energy here is that even if we don't have a slowdown, even if somehow we avoid a recession, with the volatility in the stock market, if we have a panic event, what are you going to do if you're a fund and you're getting margin called for $10 billion? You're going to pay the margin call, or you go insolvent. So you got to sell those Exxon shares. So it's one of those things where, like we talked about earlier with gold, you get that panic, the flash crash, and then it recovers, tremendously from there very quickly. But, that's the type of, I'm not saying that exactly happens, but that's also another thing to look at where, you get that period where fundamentals just go out the window for a minute because it just has to.
Okay. Well, I think this was a great episode.
That's the emotional trade.
What's an emotional trade, Lee?
I just said it's the emotional trade. Yeah. The emotional trade.
Well, I'm starting to hear people talk about buying gold. I don't know if they've bought gold and gold stocks yet, but I'm starting to hear hedge fund managers that would never have bought it in the past. And they're starting to look at the math problem that the US government has coming up and the higher interest rate. And the other problem, and we haven't seen this yet either, with the interest rates priced in, we haven't seen large scale bankruptcies yet from a lot of these small and mid cap companies that had bad balance sheet and their high cost of capital is higher. So those bankruptcies from other companies and other industries, historically, that's good for gold too, because gold as an asset has less counterparty risk than a lot of other shares in companies in many industries, unless you're looking at balance sheets and you understand how to look at too much leverage debt on the balance sheet and profit margins and cash flow having a problem. So these higher interest rates will start to cause wide-scale bankruptcies in a lot of companies in different industries. Also good for gold too, historically.
Well, I think we touched on everything, guys.
Yeah, I think we pretty much touched on it in about an hour or two. So the goal was to do this for about 50 minutes or an hour. Hopefully our listeners like it. I know in the past we had people ask for me to interview Aaron. So I think this was probably as a holiday special to get his views on like reviewing 2022, 2023. But there's overall, guys, I think there's just too much intervention and bad policies from these governments and central banks, and they're creating these distortions. And that's why you see all these hedge fund managers go on podcasts and they're coming up with weird trades where they're going to short inflation and go long oil or stuff like that. And you're like, that doesn't make any sense, though.
Yeah, we'll have to. Well, that's a new one for me.
Hey guys, thank you so much.
So thanks everyone for listening to the holiday special episode number 15 of Finance Unspun. We really appreciate it. And we'll have Aaron back on for maybe we'll do a half year review. If Aaron wants to come on during the summer, and we'll do a half year review of some of the stuff we discussed on here. That would be pretty good. Maybe get Aaron on at least twice a year on Finance Unspun and have a little discussion with the three of us.
Yeah, for sure.